Welcome to The Explainer. Today, we're putting on our expert investment analyst hats and submitting Enviri Corp, ticker symbol NVRI, to an absolute gauntlet of a stress test. We've got a mountain of financial data, and we're going to run this company through the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, plus some modern discounted cash flow models. We're going to find out for sure, is this stock a hidden gem, or is it a classic value trap?
Here's our roadmap for the analysis. We've got 6 steps. 1. The Enviri Corp snapshot. 2. The Warren Buffett lens. 3. The Peter Lynch lens. 4. The Benjamin Graham lens. 5. DCF and alternative valuations. And finally, number 6, synthesis and final verdict. Let's get right to it.
Section 1. The Enviri Corp snapshot, a company in transition.
All right, so let's establish our baseline. Enviri is an industrial and environmental management company heavily tied to the steel and rail industries, and right now it is in the middle of a massive, fundamental transformation. The stock is currently trading at $20.82 a share, giving it a market cap of around $585 million. But you know that number? It only tells the pre-transformation story. Historically, they've been battered by high debt, legacy contracts, and some serious supply chain delays. But they're making massive moves right now that are literally rewriting their financial DNA.
Here is where it gets really interesting. Enviri just sold its Clean Earth division to Veolia for a staggering $3 billion. Why? To completely de-risk its balance sheet. So now we have to evaluate the new pro forma reality of their remaining environmental and rail divisions, what they're calling New Enviri. Look at the shift. Historical 2025 revenue was $2.24 billion, but looking ahead, pro forma revenues will shrink to roughly $1.2 billion, with $140 million in adjusted EBITDA. That's essentially their core operational profit. But the real kicker here? That absolute mountain of historical debt is being slashed, leaving them with a much healthier net debt to EBITDA ratio of just 2.0x.
Moving on to Section 2, the Warren Buffett lens, seeking moats and consistency.
So how does Enviri hold up against the Oracle of Omaha's extremely strict criteria? We know Buffett absolutely loves economic moats, predictable earnings, and pristine management. And surprisingly, Enviri actually possesses a really strong economic moat. Their Harsco environmental division is literally the largest provider of on-site environmental services to the global steel industry. They operate at over 120 sites across 30 countries. And these aren't just quick gigs. We're talking long-term, 5 to 7 year contracts with super high retention rates and fixed minimum billings. It gives them a highly defendable advantage and incredibly clear revenue visibility. So on the moat front, Buffett would definitely give it a thumbs up.
However, the historical math, well, it's pretty ugly. Buffett demands a high consistent return on equity. It's his key measure for how efficiently management is compounding capital. But for Enviri, the trailing ROE is a staggering negative 44.6%. Yeah, negative. This is largely because their Harsco rail division has been bleeding cash due to some major cost overruns on these complex engineered-to-order contracts with European rail networks.
So, when we run Enviri through the full Buffett checklist, the dashboard flashes red. Economic moat? Pass, for sure. But consistent earnings? Fail. They posted a diluted loss per share of $2.03 in 2025. Manageable debt? Historically, an incredible fail at an adjusted 628x debt to equity. Now, yes, it's dropping to 2.0x post-sale, but the track record is tough. And owner earnings? Also a historical fail. Because of those negative earnings and a total lack of historical consistency, Buffett would pass on this stock entirely. There's just no margin of safety or predictability that he requires.
Let's flip the script. Section 3, the Peter Lynch lens, spotting the turnaround.
What if we view Enviri not as some consistent stalwart, but as a transitional play? Peter Lynch loved finding value in places where everyone else was just too afraid to look. He categorized companies into specific types, and Enviri perfectly fits 2 of his absolute favorites, the turnaround and the asset play. Sure, they've been battered by those legacy rail contracts, but they just pulled off a massive $3 billion asset sale. This is exactly the kind of radical corporate restructuring that makes a Peter Lynch investor sit up and pay attention. Now, when we actually try to run the numbers and calculate Lynch's favorite valuation metric, the PE ratio, which compares the PE ratio to the growth rate, we kind of hit a brick wall. Because of those heavy losses in 2025, Enviri has a negative PE ratio of roughly negative 2.6x. And you simply can't calculate a meaningful PE ratio with negative earnings. So on a purely quantitative basis, we have to assume it fails his primary screen for now. But wait, despite the broken PEG ratio, Lynch would be all over this balance sheet fix. They literally used the Clean Earth sale proceeds to pay down $1.2 billion in debt. That completely wiped out the revolving borrowings and near-term maturities. Plus, they paid out a $1.3 billion special dividend to shareholders. Add to that the active restructuring to de-risk those bleeding Harsco rail contracts, and Lynch would likely rate this a speculative hold, or maybe even a cautious buy, if you're an investor with the stomach for a classic turnaround play.
All right, Section 4, the Benjamin Graham lens, the defensive investor.
Next up, we subject Enviri to the ultimate conservative stress test. Benjamin Graham, the father of value investing himself, was absolutely ruthless when it came to demanding a margin of safety. Running through his defensive checklist, adequate size, with $1.2 billion in pro forma revenue, it easily passes. Strong financial condition, it's borderline, sitting at a 1.1x current ratio. But earning stability, with negative EPS, that's a hard fail. Graham wants years and years of positive, stable earnings, and Enviri simply doesn't have that right now.
And this right here is the final blow for the Graham analysis. When we try to calculate his famous intrinsic value formula, taking the square root of 22.5 times earnings per share times book value per share, the formula literally breaks. Since the 2025 EPS is negative $2.03, you end up with a negative number inside a square root. Mathematically, it's impossible. Graham wouldn't touch this stock with a 10-foot pole at the current price. It offers zero margin of safety under his strict parameters.
Let's look to the future. Section 5, DCF and Alternative Valuations, the Forward View.
Okay, so the old guard historical screens totally rejected Enviri. But let's shift to modern, forward-looking valuation models. S&P Global Ratings expects the new Enviri to generate funds from operations, which is the actual cash the business brings in, of $100 to $125 million annually once these one-time transition costs fade. If we use a conservative $100 million as a proxy for year-one free cash flow and assume just a modest 5% growth rate as the rail division slowly gets back to profitability, we can actually build a solid forward-looking discounted cash flow model.
Assuming a standard 10% weighted average cost of capital, basically the return investors expect given the turnaround risks, and a 2% perpetual terminal growth rate, our base case DCF model starts looking very interesting. If we play around with a sensitivity table, altering the WACC and growth rates slightly, we get a fair value per share hovering right around the low to mid-20s. At the current price of $20.82, the DCF model suggests the stock is fairly valued right now, or maybe even slightly undervalued if management executes this turnaround perfectly.
Backing this up with alternative models, Wall Street analysts are actually way more bullish than the historical formulas. The median price target among analysts is $26 per share. That implies a nearly 25% upside. Plus, if we look at enterprise value to EBITDA comparables, the new pro forma structure, with that 2.0x net debt against $140 million in EBITDA, brings NVRI much closer to industry standard multiples. That suggests the broader market really hasn't fully priced in this newly cleaned up balance sheet just yet.
Bringing it all home. Section 6, synthesis and final verdict.
Let's bring all of these conflicting narratives together to deliver a final, blended verdict on Enviri Corp. Here is the ultimate scorecard, and it perfectly captures how historical, backwards-looking philosophies violently clash with modern turnaround projections. Historical value investors like Buffett and Graham, absolute sell. The negative trailing earnings and historical debt are total deal breakers. But forward-looking turnaround analysts, using Lynch's asset play theories and modern DCF models, they see significant upside hidden in the new capital structure, and Wall Street's $26 target clearly leans right into that turnaround narrative.
So, the final recommendation really rests on balancing these key factors. The strengths are undeniable, right? A newly de-risked balance sheet, a highly stable environmental moat in the global steel industry, and a massive $3 billion cash injection that totally removes any immediate bankruptcy risk. But the risks, they are equally stark. The Harsco Rail segment is still burning cash on legacy contracts, the trailing earnings are severely negative, and we can't ignore the ongoing macro volatility in global steel production.
Ultimately, evaluating Enviri forces you to answer a fundamental question about your own investment philosophy. Are you investing based on the safety and predictability of the past, or the mathematical promise of a restructured future? At $20.82, Enviri is a definitive hold for conservative portfolios that require historical stability. But for risk-tolerant investors willing to bet that management will successfully fix those bleeding rail contracts, the new balance sheet makes this a really compelling speculative buy. So, does your portfolio have the risk tolerance to weather a volatile turnaround? That is the question you have to answer. Thanks for joining me on this explainer, and I'll see you next time.